Disney's earnings. The company's stock moving to the downside after mixed results. So for more on Disney earnings and that share down a little over 8%, we're going to bring in Anthony Forcione, Rockland Trust Vice President and Portfolio Manager. He is also a Disney shareholder. Anthony, thank you so much for being here this morning. I want to start by asking you about Disney's pricing power, because I'm curious how much pricing power you think they still have, and whether to you you'd view this earnings print as defensive in terms of cost cutting or potentially offensive and showing you that there's more growth to come for this name.
Good morning. Thanks for having me. So in terms of pricing, they definitely have a lot more pricing power within their portfolio. Today's print certainly brought a little bit more exciting action than I would have imagined. When you look at the numbers, they were a very solid quarter, raised guidance for the year, reiterated their outlook on free cash flow and cost efficiencies. But at the end of the day, I think the market probably wanted a little bit more and was a little bit worried about sequential guidance in their theme parks, which when you take out the one-time costs are going to be completely in line. So when you look at pricing, they do have still power in their theme park, and then certainly within the DTC business as they continue to optimize that model.
So Anthony, is this a buying opportunity then when you see the stock off 7.5%? Is this a reason then maybe to get in and position yourselves for those gains?
Yeah, I think when you take a wider lens, the longer term opportunity is still there. When you look at the DTC business, we've got a great view on this business. When you look at Netflix's business, while not exactly the same, certainly comparable enough to say this business is entitled and should get margins in the mid-teens or perhaps even higher as they continue to evolve the model internationally. And that equates to $3 billion plus of operating income and $2 plus in earnings power. And I don't think that's reflected in the stock yet. And I think what investors are also underestimating is this cash flow continues to compound. There's optionality in terms of returning capital to shareholders that's not reflected in the stock. So I think the risk reward is still good.
But when do you think we might get that capital returned to shareholders then?
Yeah, we're already seeing it. They repurchased a little over 1 billion shares this quarter. They instituted a dividend also recently. So that is happening. And I think will continue to happen as they continue to compound cash. And I think another strong element is that, it's been an unprecedented time in their studio production, and that should be a lot better going forward that, continues to energize the flywheel they have.
And then we take a look at some of the headlines that came out of the earnings call here earlier this morning. They talked about the third quarter profit to be impacted by cruise costs, by inflation. They also went on to say that parks growth was, quote, moderating from peak post-COVID levels. When you take that into account, how big of a challenge of a headwind do you see inflation if we do remain at these levels, stickier than many had forecasted to be at this point? How big of a headwind is that for Disney, at least in the short term?
Well, it's somewhat of a headwind for Disney as they're a consumer-facing company, and they talked about that with higher wage costs for their business. But ultimately, I think it falls back onto the pricing power they have. They provide a very, very unique experience to consumers. And when you think about the theme park business, again, looking at a wider lens, I have no concerns over this business over the longer term. It's a fantastic business. They're going to be putting a lot more capital into it over the next 10 years. Tremendous opportunities for expansion and invigoration in terms of new attractions. So I think this business is going to be much bigger over the next 10 years.
Well, I'm curious, too, about the streaming business, Anthony, because I know that there have been questions, especially to the CFO who we spoke with earlier, the Yahoo finance team, about Hulu's valuation and any potential deal making surrounding it. Are you looking to hear more information about a potential deal, and would that make you more bullish on this stock?
Yeah, I think we are going to hear more news in the coming weeks and quarters, certainly on Hulu. They've got to decide on the right valuation, and I understand they're bringing in a third-party evaluator to do that. And I think that'll be settled shortly and probably acts as sort of a near-term catalyst to sort of have that behind us. And that's a huge opportunity, and they talked about it in the quarter a little bit, how they've added the Hulu tile within Disney Plus, and that should increase engagement, lower churn, lower marketing costs, and then, ultimately continue to build value for the franchise.
And then when we talk about the longer term prospect here of Disney, we got to talk about succession, what exactly Disney is going to look like under Iger. What are you hoping to hear in the coming quarters, and how do you expect this to play out?
Yeah, it's a great question. We heard about it a little bit on the call today, how the board is obviously very focused on that's a succession planning. ultimately, they're going to work with Mr. Iger and settle on when it's the right time for him to leave. But it's a really important decision for them, given the recent management changes that they had. So I think this is a really, really important point for the board to do this properly and correct, and take on this actually very difficult challenge of finding the next CEO of Walt Disney Company.
Anthony Forcione, we really appreciate you taking the time here joining us this morning. Rockland Trust Vice President and Portfolio Manager. Thanks.